Welcome to TheoTRADE. This is Don Kaufman. It's December 13th, 2023. It's a Wednesday afternoon. It's a Fed day. We are explosive to the upside after, of course, hearing Jerome Powell. It's what I would call a Powell keg of market risk to the upside. Let's get to work here on this evening's video. So right now, we're actually kicking it off looking at the SPX. And the reason I want to look at the SPX is what I'm about to highlight on your screen right here. Right there at about 4670 inside of the SPX. That happens to be none other than the upper edge of the expected move for the week. And that implies we are very much outside the expected move, which again, I'm going to cover pretty extensively towards the end of this video because, you know, this 4670, this is going to be critical for the remainder of the week. No doubt, this is a rather explosive move in markets as the Fed, listen, they went kind of double down dovish, which I've been shocked that people have been talking about rate cuts. But the Fed, I don't want to say that they confirmed that, but in 2024, the dot plot now actually displays as much as a 75 basis point cut, which means it would imply 3 rate cuts of 25 basis points or, a 50 basis point cut and a 25 basis point cut in 2024. And I got to tell you, the marketplace, it doesn't hesitate. That's all it needed to hear before what amounted to, as I said, it's a Powell keg of market risk to the upside. But before you get too far ahead of yourself over here, there's definitely a much deeper conversation piece in the midst of this upside move, and that's this. One of the things that's pretty apparent, okay, in some of the upward momentum right now is where that upward momentum happens to be coming from. Let's get down to business over here. So you got the S&P is ripping to the upside on a percentage basis. They're up about, let's call it 1.2%. The Nasdaq, though, is actually lagging a little bit. And again, let's get really specific and start to look like stocks that have actually led, okay, broad base led most of the rally. They're not involved today. And that's curious to say the least, because we saw this kind of price action earlier this week where all of a sudden big tech was down and down, through and through, and the rest of the marketplace was up. Okay, we're not quite at that point. Again, I actually want to show you right now, like the advanced decline line. The advanced decline line, you're like, it's ripping, people. Okay, this is what we would quantify as just full-blown correlation. It's basically everything in the S&P 100 happens to be up. Moreover, I'm actually going to take a detailed look right now at the Nasdaq 100, because you look at the Nasdaq 100, okay, we're there. The things are correlated. 90 stocks trading to the upside. So what do you, who cares? It's it, man. It's just this huge rip and rally to the upside. But it's not. There's a few odd stocks out. Again, the performance that you're seeing, okay, out of this marketplace is simply not in the big tech stocks. Okay, Nvidia, none of them. Like Nvidia, it's not even up with the Nasdaq. Tesla, it's only up 0.5%. Meta's completely flat. Google, slightly down on the day. Amazon, Amazon's doing all right, up 0.6%. Apple is the only thing making a move. And quite frankly, it only has to be Apple. But again, it is interesting to see this because the Nasdaq has a degree of underperformance. There was also just about a half hour ago, there was a brief and fleeting moment. As soon as Jerome Powell stepped off the main stage, we had the Nasdaq actually pull in by 120 handles. The Nasdaq was literally, came off 120 handles. You're like, oh my God, we're coming down. We have a bid back under us. But look, people, still 10 minutes left to trade. It is not over in today's trading session. And again, I'm telling you, there is divergence in the force because I've argued for the longest time that when you're looking at like advanced decline lines, specifically looking at advanced decline line, like in the S&P 100, in theory, you could have 90 stocks trading, okay, to the upside. Again, you could have 90 stocks trading to the upside with the S&Ps actually selling off. It just is wholly dependent upon big tech. And right now, big tech is clearly, okay, diverging, if you will, to the downside. There's no more performance out of those. And this actually lends itself to something really interesting to discuss. And that's the fact that the financials, okay, are the leader in the pack. I know that you can find other stocks and other stuff is up. Okay, I got that. Okay, but when it comes to big sectors, influential sectors, what do you got? You got financials, you got some energy. Energy's got a bid under it, but energy hasn't had a bid under it in months, right? I mean, it's literally been 2 months since energy's had any bid under it, and energy's got a little bit of a bid. But the financials, this is shockingly scary because the financials are ripping higher, yet the Fed is actually saying, "Nah, it's all right, man, because we may actually turn around and lower rates." Okay, that's not what you would anticipate for lower rates. Let's buy financials. What you're seeing over here is actually some performance gaming into the end of the year. This is a whole lot of portfolio managers that must be critically behind on returns, and they're just forcing capital into any place they possibly can. If something has a trend, people are buying it, okay? But that trend is definitely, okay, off right now, these big tech stocks. So this is going to be something to watch into the end of the week, which brings me right back to the fact that you start taking an objective look at this, and we'll come back to the SPX for a second. So the entire trading week, you're looking for just about, and I'll zoom out for a second, we're looking for about a $65 move on the SPX. Obviously, we hit it and crossed through. There's no question about it, right? We're home, okay? But now, all right, let's see if this edge of expected move kind of holds. What I'm implying with that one is, are we going to pull back right to that 4670? Do not be surprised if you see that either early tomorrow or throughout the course, possibly even into the evening session, that we actually revert back to what I would term like a little bit of a happy place. That 4670, though, I don't think we've heard the last of it throughout the course of this week. It is largely, though, okay, up to Nasdaq stocks. Again, what we're seeing right now is a little bit of performance gaming where everything that's had unbelievable performance is not being bought. Okay, anything that's kind of lagged behind, you're a winner. I mean, you look at stuff right now like Boeing. Okay, this is shocking. This is not about fundamentals. This is about portfolio managers screaming out in pain because they haven't had the performance that the S&P has had on the year. That's what this is really about when you look at something like Boeing, when you're like, is it, and has it had a down day? You start looking at this at auto expected moves, and okay, it's shocking. Week in and week out, okay, that's performance metrics. And I'm not saying exactly when it's going to come to an end, but believe me, this does in fact come to an end. And it's dangerous when we actually have big tech and you realize the magnitude of big tech. Okay, how substantial it really is. But right now, so long as we have Apple bid, markets are actually going to hold it together, at least into today's close. All right, a couple other aspects. Big hit, okay, to the US dollar. So the US dollar has been kind of retrenching back to the upside. It got completely annihilated and smashed over here, throwing gold 2% higher. I mean, just massive moves inside of a lot of the commodity products as, again, some wild trade inside of the dollar. The other aspect, and I got to tell you, I'm astounded by the move in the bonds, okay? This move back up in the bonds, again, makes me want to take the opposing side of this all day long. I have no problem saying, okay, love to be a contrarian. But in this case, I mean, the bonds too far, too fast. The bonds almost look like Boeing. Now, granted, the bonds have had one of the most magnificent, that's a 10-year chart, one of the most magnificent crashes in the history of bonds. And they've definitely got a bid back under them. I just don't think it's sustainable at this point. So I will look for opportunity. And I've actually taken some opportunities inside TLT, but I'll look for some opportunity to take the other side of this move inside of the ZB in the very near term. Look, remainder of the week. The remainder of the week. Let's cruise over to the SPX. As I said, a possibility of a pullback into, again, the upper edge of the expected move is something that, again, I would look for to the 46.70. Okay, but what's volatility looking like? I mean, you can talk VIX all you want, but VIX is 30 days out. It's not going to help you. What's really, really entertaining is that the entire week held, okay, what? About a $65 expected move. You realize there's only Thursday and Friday left. We still have almost a $50 anticipation of movement. Why is this interesting? Because you would expect that volatility would have been crushed, and the life of volatility would have been crushed out of this marketplace. That's not what the SPX is saying. And that's why I keep telling people the VIX, it's not what it used to be. Okay? It's not the effective tool. You look right out what's in front of you. And I'm going to tell you right now, 17.5 vol. Okay? Why has vol elevated with a rally in this marketplace? Look, people, things, they are interesting. Okay? As I said, it's a Powell keg of market risk to the upside. But we're actually seeing short duration option volatility expand with the market headed higher. Thanks everybody for joining us here at TheoTRADE. Have a wonderful evening. Bye-bye.